Good morning, everyone. I am Teresa Mueller. I am chair of the CGBN Global Committee for NICAR, and it is our objective to bring together commercial practitioners across the world to network and hopefully get deals done. And working with me also is Ahmed. I'm going to have him talk a little bit. And then after that, we are going to have our presenter, Brandon Speck, talk about promising commercial real estate trends in some of the gateway cities. And after he presents, we will have a question and answer session and then a commercial needs and wants networking session after the questions and answers, which that session will not be recorded. If you have any questions at any point, please feel free to put it in the chat, as well as all your contact information. And a couple of things to note before I start presenting them. Ahmed might give a little bit of history in terms of what we're trying to do here, but we will have a different presenter every month. We are starting with the US this month, but generally we are looking for commercial practitioners outside of the US to talk about market trends, upcoming opportunities, things to watch out if you're investing in those countries. So from all over the globe, we've had a whole series last year from Canada, Mexico, India, and we have all those sessions recorded. So of course, if anyone has anyone that they highly recommend as a commercial practitioner outside the US, we would love to have them on our presenting series. And of course, this topic is fantastic because we're going to get a glimpse of what's happening in the US. But next month we are going to talk about, or we're going to talk with a developer out of Latin America who has developed in multiple countries. But the main topic he's going to touch on is crypto and cryptocurrency. So without further ado, can Ahmed, if you can give us a little bit of background about the global perspective and what we're trying to do here.
Thank you, Teresa. So, you know, the folks that were right at the very beginning of setting up the commercial global business network, Bill Caton, Andy Wagner, Paul Martis, and then, you know, a host of other folks that are just not practitioners, but also professionals, from attorneys to business consultants. Excuse me. So last year was the first year, and I chaired the council last year for 1 year. And as Teresa mentioned, you know, our networking is basically global. So we've had events done with people from all over the world. I am the National Association of Realtors Global Ambassador to South Africa, Nigeria, and Ghana. And so we're looking forward to do programs with these countries that I have, that I represent, but also we have over 100 organized real estate associations around the world that we have the possibility of making this connection and network and go ahead and do these programs. But welcome everybody, and I see some faces. Ron Sears, who has left Chicago, but he's very much still with us. Welcome, Ron, and everybody else that's on this webinar today. And thank you, Brendan. I've you know, been a follower of Brendan every year through the inland event that's been going on, and he's the best out there in the industry. So thank you, Brendan. Thank you for being here with us. Teresa, back to you.
Thank you very much, Ahmed. And just as a reminder, everyone, if you could please mute yourself if you haven't already, and please feel free to share your contact information, whatever you think would be useful in the chat, as well as your needs and wants. And again, we will have a networking after Brandon. Also, please feel free to put your questions. It would be helpful if you capitalize a question for me to make certain that I highlight it after his presentation. A little bit about Brandon, because I'm sure I'm not even going to say enough, but I have been to multiple of his presentations. He is the director for U.S. Retail Analytics at the CoStar Group, but he not only is extremely articulate, but is very good at the data analysis. and pretty much anything that you want to know about commercial real estate. If he doesn't know, I bet you he could figure it out in terms of the data. So he has prior commercial real estate experience prior to CoStar, but he has been amazing in giving multiple presentations for city specific throughout the US. And he is a wonderful resource for CoStar if you ever need it. So today, Brandon is going to talk about promising commercial real estate trends in the US. And without further ado, it's all you, Brandon.
Great, thank you, Teresa, and thank you for the very warm and kind welcome. I'm not that great, I promise, but certainly you made me feel like I was. So, worth tuning in just for that. So great to be with everybody today. As Teresa mentioned, my name is Brandon Speck. I'm the National Director of Retail Analytics for CoStar, still moonlighting as the Director of Market Analytics for Chicago. CoStar, for those of you who aren't familiar, primary data platform to the commercial real estate industry within the US, also owners of apartments.com, loopnet.com, homesnap, homes.com, and a whole host of other websites coming soon. So great to be with you today. Teresa approached me about putting this on really as a way to find some, I think, positive trends to talk about within our gateway cities. As we all know, the pandemic hit a lot of our gateway cities and our urban areas especially hard. But we've seen some really, really strong rebounds and some really, really positive signs of life and a bounce back within not just the economies and the day-to-day life, but within the commercial real estate markets as well. So today I'm really just going to discuss some of those positive trends that we are seeing and really how they're impacting some of our major gateway markets. Let us remember, right? Man is urban, right? Man has been urban for hundreds of years and will continue to be for hundreds of years into the future, right? Whether it be for socialization, for experience, for networking effect, for the economic impact. Man is an urban creature and will continue to be an urban creature, right? And so I think with every wave of whether that be a pandemic or 9/11 back in 2001, there's always been, anytime anything happens to the urban environment, there's always a lot of people who want to call the death to the city, right? Or the end of the urban environment, or the end of the urban growth experiment that really has propelled the United States forward over the past couple of centuries. And frankly, we don't believe that that's going to come to fruition. Actually, we think we're seeing signs already of the fact of just how short-lived that trend was. And we're going to go through some of that data today. So just want to confirm you are seeing my screen. Teresa, maybe a thumbs up. Are you seeing my screen? Fantastic. Let's get to it. So we're going to start first and foremost with something that may not look positive on the face, but frankly really is. And that's just the upward trend that we're seeing in daily office occupancies. I know obviously Omicron certainly threw a wrench into things during the end of the year, right around Christmas time. And so we do see these daily office occupancies dip, but they've bounced back, quite frankly, even in the face of Omicron, much stronger than I would expect. And to me, when we look at this data and we look at mobility data, it's showing me that the American consumer and the American worker is bouncing back quicker this time than it had from each prior wave of the coronavirus pandemic. We're now starting to see some positive trends as far as hospitalizations rolling over and start to fall, overall cases rolling over and starting to fall. And frankly, we're seeing some really, really positive trends on the health front that says the worst of the Omicron wave is behind us. And if that's true, that's going to be really, really good for our gateway office markets, right? Because our gateway office markets rely on the strength of that network effect, right? Rely on the strength of getting people from codependent industries or clients and providers together in a very tight environment, right? And then fostering and reaping the benefits of that environment. We need to get people back into the office though. And the positive trends we were seeing pre-Omicron and the quick snapback we're seeing in a lot of these markets, frankly, to me is a positive sign, especially when we compare that or put that alongside some really positive trends we're seeing in office leasing. So here is just the total amount of square footage leased across office markets. And as we mentioned, right, gateway markets really took it on the chin, right? Especially there was really no segment, maybe other than hospitality and convention markets, that really got hit harder than office markets in gateway cities. But we've seen a really, really quick snapback to record levels of office leasing activity across these major 8 gateway markets here. So you can see Miami, Chicago, New York City, LA, Seattle, San Diego, San Francisco, Houston, right? Using these 8 cities as a bucket for overall gateway momentum, you can see how much activity really troughed in 2020 Q2. That was obviously the depth and the height of the uncertainty during the pandemic. But I took a 1 quarter previous look back just to look at 2020 Q1. And the reason is because while the pandemic did technically hit, the US, I would say, in full force and in March, and that's really when we started to feel the world coming to an end. January, February, and for the most part, most of March's leases were unimpacted by the pandemic, right? We didn't see a huge hit to the data in Q1 2020. It actually stands as a decent proxy for pre-pandemic levels because so much of the activity was already baked in by that time, right? It was really late March by the time we started to see the true impact of the pandemic. So when we compare 2021 Q3 specifically, and then Q4 overall leasing activity, you can see we're much, much higher than what we recorded across these 8 markets. And while some markets are bouncing back quicker than others, namely Chicago or New York, which had a really, really strong record 2021 Q4 when it came to office leasing activity. All of these markets are certainly much higher today than they were off of their trough. So when we take things such as rising office occupancies and we compare them to the fact that employers themselves are now saying, we're going to commit for more office space across these 8 gateway markets in the 4th quarter of 2021 than we ever have. That to me bodes well for just the confidence in the urban environment and within these markets, because obviously once you have the office leasing activity, then you get the workers into the metro area, and where the workers go, now all of a sudden we start getting that foot traffic back. We start seeing that retail, that ground floor urban retail bounce back, right? And it sets just a catalyst for positive economic momentum throughout these markets. So certainly, one of the forward-looking indicators that we're looking at as we try and find some positives in large urban office markets is this leasing activity. Now, you won't see this yet in the demand data. A lot of our demand data, if you go into CoStar right now and you look at 2021 demand, it fell in a lot of these markets. But what this tells me is that the trajectory going forward is positive, right? Because generally speaking, the leasing always is a forward-looking indicator for where demand is going, right? Because typically there's some lead time, whether 90, 120, sometimes 180 days on a lease signature before that tenant actually in fact moves into that space. So we're expecting 2022 to be a very good year for these 8 markets specifically. Probably the only one where I'd say we haven't yet seen the same or a really strong snapback is still San Francisco. It's still feeling a little weak, but momentum is picking up. So overall, though, looking at a very, very positive 2022 relative to the really, really depressed 2020 and 2021 we saw in the office markets across these markets. Another positive trend, certainly in sometimes it's the tail, sometimes it's the dog. Another really positive trend that we're seeing is a bounce back in apartment absorption across these markets. So certainly at the depths of the pandemic, we saw a strong increase in absorption in secondary markets, tertiary markets, and vacation markets, right? As people use that newfound freedom really to go work from anywhere, right? And a lot of them ended up, in ski towns or in beach resort towns. Who wouldn't want to? I have 5 children, so I didn't get that option. But if I didn't have 5 children, you better believe I would have been working from a ski town, Teresa. We're seeing some really, really positive absorption snapbacks now as the market seems to be starting to get back to normal. So we actually recorded record levels of absorption across these 8 markets. So again, Miami, San Diego, San Francisco, Chicago, Houston, Los Angeles, New York, Seattle. These are the 8 markets we're looking at here and what we're comparing. And I know, I'm sorry, this looks a little messy, but I like to give people a historical comparison, right? Because in order for you to understand what 2021 meant, you got to kind of understand where we were in 2019 and where we were in 2020, right? So you can see, for example, we can take Houston, our biggest outperformer over the last 12 months, recorded nearly 38,000 units of positive demand in 2021. What does that mean? That means On a net basis, if you count all of the people moving into units and moving out of units at the same time, there was a net positive 38,000 unit increase in demand in Houston just in 2021. So these are trailing 12-month figures, right? So as you look at that line, that's a kind of a continuously rolling 12-month figure, such that in any quarter, you understand how many units did we absorb over the prior year, just so that everybody understands how to read that chart. But you can see really how things troughed during Q2, Q3 of 2020, and just how quickly they've snapped back. Now, obviously, there's a lot of factors at play here. Certainly, there was a depressed, demand that the depressed demand that we saw in 2020 certainly led to some pent up demand in a sharp rebound in 2021. Also, we have to remember just the role that the federal government, sprinkling of trillions of dollars into bank accounts had on both our apartment market, on our housing market, on retail sales, and by extension, retail demand. So certainly the fiscal or the role that the government played in providing all of that fiscal support, I think it had a lot of positive impact. And as I mentioned, the housing market, right, with the fiscal and the monetary impact resulting in people having more money for down payments. So seeing a spike in demand, right, monetary policy sending interest rates lower. But at the same time, we weren't really building that many more houses, right? So as most of us probably know, inventory on the single family side and on the for purchase side shrunk to record lows. Well, that was a wonderful support for our apartment market, right? As it pushed people who maybe otherwise would have been considering buying, but just due to lack of shortage of inventory, due to being priced out of the market, due to just being a little bit queasy about paying 22% more today than they would have a year ago, pushed those people into the apartment market and contributed to this strong absorption that we saw. So death of the city, I don't think so when we're absorbing a record level of multifamily units across these cities and when we're recording a record level of total office leasing. So next thing I wanted to touch on very quickly as we think about just commercial real estate and just the one-for-one relationship really between fundamental tightness and rent growth, right? At the end of the day, let us remember, right, value creation in commercial real estate is largely built on tightening is wonderful. If I get out, I want is rent growth. Right? When we see this record levels of absorption across these state markets with support 21. So what we're looking at is my little chart. You can first correspond to the various metrics over the. So for example, our underperformer, our worst performer was New York at 5.9%. 5.9% rent growth is phenomenal rent growth. Right. If we go all the way to our outperformer, Miami, 18% rent growth. So phenomenal growth across the board. Right. 4 of these 8 markets had double-digit rent growth, and 6 of the 8 were over 8%. Right. So this is historical levels of rent growth for pretty much all of these markets except New York. And New York and Los Angeles were the only that didn't see a new record historic high for annual rent growth in 2021. And at the same time, again, as I mentioned, we were seeing all of that absorption. So when we look at occupancy growth, right, or the change in occupancy rates across these markets, you can see that each of these markets saw strong occupancy growth as well. So for example, Houston, Texas, right, which saw about 9.5% rent growth year over year and 4% occupancy growth, right? The vacancy fell by 4% in Houston in 1 year. That's phenomenal absorption and phenomenal demand. And again, as we start to think about this household formation growth begets what? Retail growth, right? Retailers still follow rooftops, even in the bifurcated world that we're in today, right? And office users oftentimes are following rooftops. Again, sometimes tail, sometimes dog. There's a very positive lift effect that happens when you're seeing occupancy growth figures like this. And obviously from a landlord perspective, some really positive wealth creation you're seeing when you're looking at rent growth figures like this. The other positive thing I would say is that while really, really strong in 2021, gateway markets actually underperformed from a rent growth perspective. So those markets, the average rent growth across all of those markets, New York, obviously with its weighting really weighs that down a little bit, but overall 9.8% average growth across those markets in 2021. And you can see that actually was below the national average. The entire apartment market across the country was just stupid, crazy hot, right? But as we look forward to CoStar's forecast to 2022 and 2023, you can see that over the next couple of years, right, the rents are actually expected to outperform in gateway markets. And let us remember, I don't want to buy yesterday's rent growth. I want to predict tomorrow's, right? I don't want to pay for yesterday's rent growth. Right. I don't want to pay for the fact that rents were up 18% in some of these markets. But in some of these markets, if I'm going to expect to outperform in the rent growth in the future, now that's all of a sudden something I'm willing to pick up for. So just another, I'd say, positive trend certainly that we've identified is that the strength in these gateway markets that really started, really in Q4 2020 and accelerated through 2021, we are expecting to continue here over the next couple of years. And as I mentioned, apartment growth, right, household formation growth, more broadly, really drives retail growth. And so that's something that we've seen as a positive. I threw up more markets here because I'm a retail guy and I just had to show the world of retail. But you can see that markets, our gateway markets outside of Seattle, all saw positive absorption over the last year in 2021. And certainly that wasn't the case in 2020 in a lot of these markets, right? So I think as we've seen, certainly the consumer come back to stores, as we've seen foot traffic rebound, as we've seen retail sales, despite, albeit with a kind of disappointing December report, still holding at levels 15% above pre-pandemic days. This is creating a lot of demand for retail space out in the marketplace, just as people are consuming more dollars and more goods from brick and mortar stores now than ever. I know a lot of people don't ever realize that. People don't tend to think about it in that way. But yes, e-commerce is real. Amazon is real. Oh yeah, they're opening stores, by the way, kind of, I think, further cementing the place of the retail store network in even an online retailer's world. But at the same time, we're seeing just a record amount of goods purchased through stores. And so as that's happened, we've seen demand pick up, retail demand pick up really across the entire country, which has benefited gateway markets as well, especially southern gateway markets, right? Those markets that are seeing really strong population growth and at the same time seeing this really strong lift in buying power from their overall consumer base. The next slide I want to hit on speaks just more broadly to the overall investment market as we look at just positive trends that we're tracking. And that's just the abundance of capital and interest in commercial real estate out there right now. So we traded over $850 billion of commercial real estate in 2021. That figure will rise. CoStar, we tend to hear about 98%, that's probably a little high, 95% or so of our deals by this time of the year, but there still will be some deals that trickle in February, that we hear about in February that occurred in December, right? So this figure should grow based upon, if past years are any indication. And given that, we would expect this actually to eventually settle up above $900 billion of commercial real estate traded throughout the entire country. Now, when you compare that to the $475 billion we traded in 2020, obviously a huge leap. But even when you compare that to the prior historic high of about $640 billion back in 2019, you can see just how substantially commercial real estate volumes have grown in 2021, right? Nearly 50% more than the prior record year high. When it's all said and done, we get that additional volume in. So there's just an incredible amount of capital chasing real estate in this environment, right? Because of low interest rates, because of just the abundance in capital, because of the length of the cycle and the continuous cycling 1031 money. A lot of positive drivers that have all really combine to create this very, very favorable capital environment. So it's a wonderful time to be transacting commercial real estate really across the spectrum. So when we look at it from a property perspective, whether that be multifamily, office, retail, industrial, hotel, you can see that all 5 property types lifted substantially off of their pre-pandemic lows, and some even hit all-time record highs. So what these bars represent is it's a time series for each property type from Q1 2016 through Q4 of 2021. So you can imagine the first bar of each property type is the first quarter of 2016, and so on and so forth. And you can see that dip that occurs about 2/3 of the way through. That's the second quarter of 2020, right, when the world was shut down and nobody could even really get out and kick the tires on a deal. And you can see how activity has lifted since, but really, really spiked in the back half of 2021. And really across property types. So even in office, right, the segment that no doubt fundamentals have been hit the hardest on, traded a record amount of property in the fourth quarter of 2021. So certainly as I'm looking for green shoots across commercial real estate, it's one of them is just simply that there's so much capital chasing deals right now, and that deals are so aggressive that helps smooth over a lot of otherwise or smooth over inefficiencies that otherwise could pop up in the market, right? And including reducing the amount of distressed sales and the amount of friction in the market, given there's just so much capital and so much deal flow, right? It's most deals don't have to go through distress unless they're, retail that's lost a couple anchor tenants, or convention center hotels still that haven't bounced back. Most of those sales are able to trade at really non-distressed levels because of the abundance of capital and because of the rising tide of the overall economic lift. So when we look at this sales volume and we just break it out across the metro area, you can see that each of these top 15 major metros across the US saw sales volume in 21 Q4 that in many cases doubled the prior average sales volume over the previous 8 quarters. Now, this is aggregating all of those 5 types of investments. So for example, in New York, we saw $17.7 billion of total commercial real estate volume in the fourth quarter. That's for multifamily, office, retail, industrial, and hotel. That compares to right around $9 billion on average over the prior quarters. Been picking prior, call it quarters before the fourth quarter. So you can just really get a gauge for how strong the fourth quarter was from just a total capital placement perspective. Rest in Los Angeles, Chicago, all of these markets seeing sales volumes case is more than twice what they saw over the prior 8 quarters. So certainly as fundamentals have been, people are going to again still want to live in New York City and in Chicago and in LA. We've certainly seen capital flow back very, very strongly. I just wanted to very quickly across these markets by property type. Most of multifamily, the story's certainly been in the Southeast and Southwest, right? So you could see Atlanta, Houston, the 3 strongest performing markets outside, right? So you get New York in there, you get Los Angeles, you get some outperformers like in Orlando and Austin, Seattle, and then another just I would say of either high growth markets where there's that are attracting significant job growth that are attracting 1.5% population growth per year, right, and certainly supporting some really strong fundamentals as a result, or just really large liquid markets. Because even at a time when gateway markets were underperforming from a fundamental perspective, people still like to place their capital in Chicago and in LA and in New York because it's liquid, right? And it's stable. right? It's traditionally much more stable, and it's also generally much more supply constrained as well, right? So there are just greater barriers to building, greater barriers to supply increases that also really helps contribute and one of the best markets to invest in the country for the last 5 years. But that said, they're easier to build. They're a little bit more boom bust and a little less stable, just given a lack of, quite frankly, historical duration of proving it through cycles, which New York has, which Chicago has, which LA has, which Seattle has become, given the stalwart employers that they have really driving their tech sector. Now jumping over into office. I mentioned New York saw a really strong bounce back in overall sales volume in the fourth quarter, and a big driver of that, frankly, was a bounce back in New York office transactions. So we recorded over $7 billion of total office transaction volume in New York in the fourth quarter, and as you can see, that's more than double the $3 billion on average we recorded over the prior 8 quarters. And again, these 21 Q4 figures might rise a little bit, right? So you can see that as we speak about the restoration of confidence in investing in office and urban areas, I don't think there's probably any better example than New York, which continues to, lost space, right? Demand was down overall in 2021, but really positive leasing trends, and certainly still attracting a lot of investor capital. Now you can see across all of these markets, outside of Seattle, every other one of these markets saw an increase in the fourth quarter in the office or in total office transaction volumes, which I think is really important, because if there's any segment that still has, that has probably the greatest current dark cloud of uncertainty still hovering over it, it is still the office market, right? There's still more uncertainty surrounding the office market today, even with the uptick in leasing, than probably any of our other major property types. And as such, I think seeing investors, come back to the office well and really pick up their sales activity in the fourth quarter was a very strong positive thing to see. Retail, interestingly enough, right? Retail saw a record amount of transaction volume as well. So we traded about $160 billion of total retail volume in the fourth quarter of 2021. Certainly a lot of that activity is being driven just by demand for single tenant, net lease deals. I call them bond in a box like deals, right? Where you're effectively just clipping the coupon from a credit tenant and playing the interest rate spread game. A lot of activity there, but more activity finally starting to surround high street retail, starting to surround urban retail. As we start to see those office workers come back, as those office leases get signed and the buildings fill back up, and we start to get those daytime workers back, certainly that's going to have a really positive effect on our urban retail landscape, which is still to some effect bouncing back a little bit slower than what certainly we're seeing in the suburbs. So urban retail really dependent on continued strong absorption on the multifamily side, bringing those office workers back, having that office leasing volume translate into office workers at their desks on a daily basis, and then spending their dollars in the ground floor. Very much driven by your primary distribution markets. Feels a little bit different than when we talk about, urban office, urban multifamily, urban retail, right? Industrial is kind of a bit of an outlier, but certainly seeing strong industrial volumes across the board, seeing strong industrial demand growth across the board, even in urban environments, although a lot of those tend to be more through the micro fulfillment side. And then, as I mentioned, a lot of capital chasing deals. And so that's really helped reduce the amount of distressed deal flow that we are seeing. Interestingly enough, across our major markets, really the only markets where we've seen an uptick in distressed deal volume in 2021 relative to the prior 5 years were in our Texas markets. So Dallas, Houston, Austin, We're the only markets where we've actually seen that uptick. Otherwise, all of our other gateway markets actually reporting less distressed sales volume in 2021 than in the 5 years preceding the pandemic in 15 through 19. A lot of people are surprised by that. But again, it has to do with just the abundance of capital chasing deals. And frankly, just the, it's similar almost to the end of the mortgage forbearance, right? And for a while during the depths of the pandemic, we were all worried that the end of the mortgage forbearance was going to lead to this wave of foreclosures, and it never happened. And of course, it never happened because pricing growth was what it was, right? You don't need to have the bank come take your house back when it's gone up by 22% over the last year. You can just sell it into the inventory depressed market and move on, right? And certainly that's what we're seeing for commercial real estate owners too. Even for those deals that may need a little bit of a reset in basis, there's enough capital chasing them that they really aren't taking much of a haircut, and they're selling near full value. So finally, a couple, two last things I wanted to leave you with on the pricing front. First and foremost, the fact that we still are recording very strong pricing growth in gateway markets. It makes sense, right? When you look at those slides that we looked at indicating rents are up, indicating leasing activities picking back up in office, indicating that there's just an abundance of capital. And so sales volume's up. It's going to do wonderful things for pricing, right? If my NOI is up and there's an abundance of capital chasing deals right now, right? So we are recording that really across all of our pricing series. Hotels actually are the only one where we haven't seen a return to pre-pandemic levels of pricing. But across the other four major property types, we are recording higher pricing today than at pre-pandemic levels, with industrial and multifamily being double-digit growth since the start of the pandemic. And finally, on the cap rate sides, currently, one last bit of positive news to leave you with is that we are expecting, barring either a black swan event or the Fed getting way too aggressive, way too quickly, we are expecting the cap rate environment in gateway markets to stay very, very stable and to stay stable at very low rates, even despite the fact that we are expecting interest rates to rise, right? The Fed's going to raise them at least 3 to 4 times on the short end. They're going to start shrinking down their balance sheet, which is going to start lifting rates on the back end. Obviously, we all see the inflation figures coming out every month. So there's no doubt rates are rising, but currently our forecast for gateway markets is for cap rates to stay really stable, a little bit of lift, but really stable against the backdrop of rising rates, and really doing so because one, there is a ton of capital out there, so that's not going to allow them to rise too much, so long as interest rates don't rise too briskly. And two, where interest rates are at today relative to cap rates, yield spreads still are really, really healthy, right? If you take a 20-year look back and compare interest rates, just use maybe the yield on a BBB rated bonds, which we tend to find is a pretty great correlation for commercial real estate yield expectations. If you look at the correlation between the two going back over the last 2 decades, and you look at cap rates relative to those interest rates, right, and say, okay, well, what's that spread? The spread remains today at a very, very wide or very, very healthy ranges, right? It's why single tenant net lease deals are so attractive. And so because of that, as long as capital remains abundant, even if interest rates rise, it's not going to have that big of an impact on cap rates. Frankly, it's just going to reduce the yield spread until they rise to a point where, all of a sudden, investors start demanding a greater return. But again, against the backdrop of all of that capital out there, we think that investors are really going to take lower returns versus seeing some significant push up in cap rates over the next couple of years. And that's all I had for you. I hope it was helpful and interesting, or at the very least kept you awake. And I would love to take any questions if there are any.
That's all you have. That's a lot to absorb, right? I have a couple questions, and then others are welcome to chime in if you have questions. 2 totally unrelated questions. One, how much CoStar is tracking 1031, if at all, just obviously because that was a big deal this past year. And the other thing is when you were putting together this presentation, if there was anything that was surprising to you.
So we are tracking 1031s. So yes, there is a separate filter within CoStar when you look at sales comparables where you can click on 1031s. I would say we do a very good job, but we probably are maybe getting 95 to 98% of the universe, right? And so that's just to say that assume that the number you're seeing is slightly understated relative to, you know, as you look at the 1031 figure. So if it's saying 40 billion, assume it's probably more like 40 to 45. But it was a record year for 1031 in 2021, which was a big driver of that sales volume we saw. And then the second question, you know, as far as the thing that surprised me the most, frankly, was the office leasing bouncing back as strongly as it did in the back half of 2021. Given my new retail role, I don't look at the office side that closely anymore. The last time I left the office world, we were still looking at very, very depressed rates of leasing, right? And a lot of kick the can down the road, and a lot of employers still being uncertain over what those long-term space needs looked like. And there seems to have been a lot of certainty restored. A lot of employers seem to finally be wrapping their heads around what those 3-5 year plans look like. And we're seeing that now play out with that increased leasing volume. So that was definitely the thing that surprised me the most.
Now, would you say that some of that leasing, it's much more, you have much higher occupancy in suburbs of the gateway cities versus in the central loop districts?
In some, not on a broad-based basis, certainly. It's every market is playing out a little bit differently. You know, even, you know, take Chicago, for example, right? We have so much zombie suburban office space, yeah, that if we take out the old zombie stuff, and by zombie, I mean, you know, perpetually vacant because it's really out of place for today's tenants' needs. If we would just finally take all that stuff down, certainly you'd see a lower vacancy rate or a higher occupancy rate in the suburbs than in the city. But that's really endemic everywhere across the country. And so because of that, that does provide kind of this lift to some suburban vacancy rates. But if you look at just the competitive stock, certainly the suburbs is outperforming the urban environment. That said, it's not necessarily because there's been some flow of tenants from the city back out to the suburbs, right? This isn't a reversal of the gains that the urban environment's made over the last decade. This has really just been, I think, one, in response to cost, and you know, the cost of space in the urban environment is really expensive. And so if I'm not sure what I'm going to do and my employees are all working from home, I'm going to initially shrink it, and then if I need to, I'll build it back up. So I think you're a little bit more cost sensitive in the city when you're paying 42 a foot versus when you're paying, you know, 24 out in the suburbs. And certainly I think part of this too was just it has been more of a function of less space lost in the suburbs than, you know, space lost in the city, right? It's not, again, like there's not, as we look at the data, I can't say, okay, the submarkets within these urban environments are losing demand, these suburban submarkets are gaining demand. Okay, this is obvious, right? That's what we saw in multifamily during the depth of the pandemic. It was pretty clear, right? Negative in the city, really positive in the suburbs. Okay, there's an underlying shift happening here. Here, it was just more slightly negative in the suburbs, really negative in the city, you know, and it didn't, and we weren't hearing anything about people moving really from one to the other. It was just kind of activity stopped, leases rolled, a lot of it just rolled off the books, and it just happened to hit the city harder.
And so, and for the commercial real estate asset classes that do have higher vacancy, and so now you're in the retail role. So some retail centers are doing great, right? Like where you have anchor stores or neighborhood centers, that retail is doing great, but maybe not some of these strip malls, et cetera. Are you seeing, or obviously the traditional mall too is also having difficulty. What are you seeing in the way of repurposing of vacant space?
Absolutely. So we are actively repurposing space in this country. I think one stat I like to tell people when I show them our retail stats, and they're often amazed by the fact that retail actually looks as healthy as it does today. And then I remind them that we've torn down over 118 million square feet of out of place retail space in this country just since 2017, just since the start of 2017. That's not that long ago, right? That's less than 5 years ago. 18, 19, 20, 21. Yeah, that's right. So in 4 full years, we've torn down about 118 million square feet of retail space in this country. Retail space that was obsolete, that was too big, that was out of flavor, that was in slow growth, Midwestern, smaller market areas where maybe the major economic base moved away from the area and we just didn't need that much retail anymore. So we are doing that now more actively in our office market as well. You're seeing more office to apartment transformations in urban environments. You're seeing people be creative, I think, in trying to find that new highest and best use for those asset types, which either temporarily or on a longer term structural demographic basis, the demand has moved away from them. So certainly there's a lot of that activity playing out throughout the US. Most people try and stay in the middle of the fairway, right? So if I have a retail center or a mall that's out of place, okay, well, how can I make this a little less retail that's repurposed into boxes that fit the current tenant needs and maybe densify the site with some multifamily? There's really nothing I'd say that's been like that crazy that I'm seeing. There tends to be a select few obvious ways to take a repurposing, right? And it's obviously built on those demos and what that underlying demand looks like in the area, but definitely very active. Most of it kind of falling into a couple select buckets depending on what the initial property type was.
And then obviously in some of the repurposing, some of it may be delayed with supply chain issues, et cetera. So how are you seeing supply chain issues play out?
Absolutely. I think, supply chain issues definitely have an impact. I think to some extent, you're hearing it more probably just on you're hearing it in the headlines maybe more than it's actually hitting things on the ground. But there's no doubt that there are certain products, from the construction side that there's just shortage of. I was on a panel a couple of weeks back, and a guy who owns a lot of centers was talking about he couldn't get prefabricated dock doors, right? And there for 6 months, the guy couldn't get prefabricated dock doors. And so they had to find a new supplier here domestically in the States and work with them to get exact specifications. And it was a whole big pain in the butt. It delayed the project 3 months. So there's no doubt that supply chain issues can have an impact. Frankly, I think that their greatest impact as we think about commercial real estate as a whole is just increasing replacement costs, which has a naturally supporting factor to current values, right? So for those who are worried about the role, easy money, low interest rates, the length of the cycle, and what that's done to commercial real estate values, right? One of the best things we can see right now to support commercial real estate values holding at these record levels, right, is high inflation and continued supply chain issues that support or lift up the cost of new construction, right? Because anytime you see construction costs rise, that has a naturally positive, supporting impact, I would say, to current values.
Awesome. Another question that came in is if you're tracking new investment capital by city.
New investment capital by city.
So this was asked by Daniel. I don't know if you want more detail.
Yeah, so we are tracking, how much capital is being invested into any city across America. So you could go into the Chicago suburbs, for example, and look at Algonquin, right? Or one of those. So we are tracking, but as far as the origin of the capital, that we're not tracking at the city level. That we track at a regional, national, or international level. So we are certainly tracking how much international capital versus regional versus national capital is Chicago getting versus LA versus Des Moines, Iowa. Those are all things that certainly we are tracking. Where we don't get as specific as the city on the origin, but we do on the destination of the capital.
So one of the questions are there a trial subscription to CoStar?
There is not. Unfortunately, CoStar does not do trial subscriptions. We are more than happy to do an unlimited amount of demos, provide reports, do Zooms where we can log in and you can ask me to pull things, or it wouldn't be me. We do have salespeople who would take care of that. But we're more than happy to open the kimono and show everything we have within our product. But what we aren't, just due to data sensitivities, able to do is provide the actual subscription service. And really, it's just because the CoStar product does allow mass downloads of data. So a temporary subscription would allow somebody to go in and download billions of data points in a very short amount of time, and then all of a sudden not need CoStar anymore. And we wouldn't want that.
Another question is, what effect will higher interest rates have on investment sales?
Absolutely. In the near term, I don't think much. Certainly some segments of the market will be more interest rate sensitive than others, right? Single tenant net lease retail, perfect example, right? You might start to see a little bit of a lift on your cap rates on your Walgreens and on your O'Reilly's and on your net lease deals, right? Not in the short term though, frankly. I still think that the abundance of capital out there is such that it can withstand a 25 of even upwards of 50 basis point increase in interest rates, and really effectively the competitive capital environment keep pricing from going lower or cap rates from rising, because people are still actively bidding on those deals. You start getting into 7,500 basis point rises in interest rates, and now all of a sudden I do think you start to see some incremental impact on those interest rate sensitive, single tenant net lease being probably the best example, those more interest rate sensitive products. I think that's really where you could see that play out. And then on the multifamily side, obviously, just the role the agencies play will probably muddy the waters there a little bit. So I do think you're just going to still see a ton of capital chasing multifamily, and probably won't have much of an impact there until we start to really get a stronger 100 to 150 basis point rise.
If anyone else has any additional questions, please put them in the chat. And then, Brandon, will these slides be available if anyone wants to see them, if they email us? Are
Yes.
you able to distribute these slides?
Yes, I'll email them to you, Teresa, right after our call today.
Great. Another set of questions, and he will be wrapping up in the next few minutes. So if you have anything else to ask, please type it now. One was, can smaller affiliated groups join CoStar to alleviate some of the costs for occasional individual users? Like, are there different plans depending on usage, et cetera?
I do not believe so, but I am not the best resource for that. So if there is anybody who has any questions around CoStar product or CoStar availability, I would be more than happy to put you in contact with your local rep. Please just reach out to me. I will include my contact information on the slide deck. So it'll be on the very last slide. I'll just put it right here. And then feel free to reach out to me, and I'm more than happy to put you in touch with your CoStar account exec in your market, and they'll be able to answer all those questions for you.
All right, I think we have one more question, but I will answer. The recording is going to be available through NICAR. I don't know exactly how quickly it is available, but we will have that, I'm assuming, within the week. If for some reason you had to check out or whatever, we will have it fully recorded. The last probably question I think here is, in retail, what are the most popular reposition plays for big box?
The most popular reposition play for big box, depending on my layout, is usually just slicing my box, right? And it's just taking my big box and making smaller boxes. And there's nothing sexy about it. But frankly, given the demand we're seeing for space under 10 and really specifically under 5,000 square feet, depending on really my depth, if I can, that's my easy play. If I can't, by big box, how big of a box? 20 to 50,000 square feet, grocers, certainly are kind of the best, easiest play. If I can get Burlington, there are a few tenants who are still expanding into that, those larger sizes. If I'm up over 50,000 square feet from a footprint, then generally the most common play I would say that we're seeing, as long as the local demos will support it, would be having, raising the retail and repurposing it into a denser site with probably 30 to 35,000 square feet of retail across 5 or so boxes, and throwing up 200 to 300 multifamily units. If I'm on a site where my density, where I can get that dense, with my zoning, that's definitely, I would say, the one of the most common. and probably the best from an economic, what's going to, just as you pencil it out, create the best economic return for you.
And we were super lucky and thankful to score you as a presenter. I understand you're transitioning out of this role. So what's in store for that and you?
So I'm transitioning out of the Chicago-based role. So I am now transitioning to the National Director of Retail role. So really in that role, it is my job to lead strategy, thought leadership, make sure our analytics are on that, we're on top of our analytics, and then be a knowledge resource both for our clients as well as our team of 60 internal economists and analysts who focus at the market level, like I used to in Chicago. So excited for the next phase.
Awesome. Thank you so much, Brandon. He can also put his information in the chat. And then before you sign out, we're not signing out. We will have a networking session. We're going to soon end the recording, but you can download the chat with everyone's contact information, the questions. Contact me if you would like the slides. And I appreciate everyone coming to today's session. And if there's anything else that I can help you with, Brandon, or anyone else on the call, I'm happy to help. Thank you again. And I believe we are now ending the recording.